Right, let's talk deferred tax. So, first of all, with deferred tax, I just want to get this out of the way. This is rarely ever an issue for anyone. This is current tax. Recognize any over or under provision as appropriate. Just sort of deal with that. The question is deferred tax. What is deferred tax? Fundamentally, it's an accounting adjustment. So it's an accounting adjustment again in line with the matching concept, in line with faithful representation, and also in line with the definition of a liability or potentially an asset. So if there is a present obligation, if there is an obligation, but it's not due to whatever tax laws, we are not that we cannot see that obligation recognized. We need to recognize them. So we're either recognizing a potential liability or a potential. I like to think of it as a tax saving. So this will lead to deferred. So we're recognizing here deferred tax liability or here deferred tax asset. Now, again, in line with the conditions for measuring these assets, an asset in general, there must be a degree of reliability that we will get the profits and that the profits will come. This is generally the case with when we're talking about deferred tax assets, that there is a potential to actually get the money just because someone is, if someone is owing you money but yet they're not trading, then it's unlikely for you to get the money, so we can't recognize that. Right, so let's kind of, whoops, sorry, let's go here. Let me just go back up and see what I've written here. Oh, sorry, I've lost my work. Whoops, sorry. Oh, what happened there? I need to find that very quickly. um, Yes, here we are. So, classic case, typically we have this whole story with accelerated capital allowances. This means that the expectation is that more tax will be paid in the future as higher profits will pass through the tax computations, in effect. So we have a difference between the carrying value and the tax base, and therefore we recognize a deferred tax liability. This is pretty much the common thing. Sometimes we have revaluations, which I think I have that written just in the corner there. Yes, revaluations in the same. Oh, sorry, these are some other examples. So the other examples here are revaluations. So typically, you have a revaluation where the carrying amount, if you like, is much, of course, is now has increased much higher than the tax base. We don't recognize those revaluations in the tax base during the revaluation, and in effect, therefore, we know that more income will be coming in as a result of that revaluation over the life of the use of the asset, and as a result more tax will be paid. So there is a deferred tax liability that has to be recognized, but this is important. This deferred tax liability, key, is recognized within other comprehensive income. Share option schemes, the expense is only allowed, as you remember, well, for tax purposes, the expense is only allowed at exercise, but we are currently recognizing an expense in our income statement. So currently we are getting no tax relief. So, and we have to delay it. So in effect, it is like a delayed relief. So we, in a way, we know it will come because, if you like, it's HMRC we're dealing with. So for which we can be certain, so we can recognize a deferred tax asset to do with that expense that has gone through, because we're not allowed to put that expense through our income statement. So in effect, through our tax computation. So in effect, we're paying more tax than we should at the moment. I mean, it's also meant for smoothing out the tax charges as well. Unused tax loss is also very popular. So we have unused tax losses. We know that we will be able to carry those tax losses forward and use against future tax profits. Expectation of relief. Question mark, will there be profits to use against the losses? If there will be, we can also recognize the deferred tax asset. Right, the other issue is to do with groups. With groups, we have the question here of, as we know, we have fair value adjustments. So of course, with groups and working two, we do a fair value adjustment of the subsidiary, and by default, you will now have a deferred tax liability, because in effect, it's a type of revaluation. That's the first thing. And the other one, of course, is to do with the PERP. So with a PERP, we are removing profit And as a result of removing profit that has already been taxed, we will also be having to adjust the profits to remove the profits, sorry, to remove the taxation, and therefore we can look forward to a kind of tax rebate or tax saving, and in effect we can recognize a deferred tax asset. This is in the group, as you can imagine, because in the group we eliminate all profits, and therefore we should be eliminating the corresponding tax to that. Cool, and that is deferred tax.